Scott here, your loan man. It's great to be with you again. I wanted to address a question that I get on a regular basis from clients, especially first-time home buyers. They hear a lot of terms that get thrown around loosely, and one of them is escrow. So let's talk a little bit about escrow. The word can mean different things when it's used in different contexts, and I think that's part of the confusion. And what I want to cover today is what is lender escrow and how does it affect? So first of all, if you just think of the definition of the word, the dictionary definition of escrow, it is when there is a third party that is holding money or property for one or two or multiple other entities. And this is a contractual relationship. They have certain duties, certain care that they have to exhibit when they're caring for or supervising the money or the property that is actually in escrow. And escrow, the service is generally provided for a fee by either a licensed escrow company or a law firm. So what is lender escrow? Lender escrow is when the mortgage company or the lender collects and holds and distributes funds for your property taxes and for your insurance. So let me give you some practical examples of how this would work. So you buy your first home. Now you're also going to have to get homeowners insurance and protect the property. And the lender is going to require that. Generally, you're going to pay the first year's premium, the first 12 months, upfront to get the policy in force. In addition, you're going to begin creating an escrow account with funds that are going to be placed in this fund that will be held for you. And as well, you're going to make a contribution towards your future tax bill. And every month when you make a mortgage payment, you're going to be putting money into this fund. Twice a year for taxes and generally once a year for insurance. The money is distributed to the county for the taxes, and for the homeowner's insurance policy, they send the premium off to the company who's handling the homeowner's insurance for your property. Let's put some real numbers behind this so that I think it'd be a little easier for you to absorb how it works and how, practically speaking, how it would actually happen and how it would actually affect you. So you purchase a property, let's say for $500,000 for $500,000. Let's say you put 10% down. Well, now you obviously have a mortgage balance of $450,000. Let's say that the annual cost of the homeowner's insurance is $1,500 a year. Okay, so of course, that's $125 a month. I know that my clients in Miami are going, what the hell? $125 a month, there's no way. But it really depends on where you live in the country and what kind of insurance you have. So it can vary very wildly. Let's say your property taxes are $5,000 a year. So of course that's $416.67 a month. And so you're going to make your mortgage payments. And if you owe $450,000, add an interest rate of 6%, that's $2,697.98 a month. Then we're going to add to that to determine your monthly payment, the mortgage insurance, which is generally not going to go into your escrow account. But in this example, let's just say that's $200 a month. Plus you're going to have your homeowner's insurance of $125 a month. And we've already determined that your taxes are $416.67 per month. That's a total monthly payment of $3,439.65. And that's the amount of money that's actually due every month that you're going to be paying either by check or online or however you handle your bills. Now, what does this mean? It means that the lender is collecting these funds and they're distributing them as needed. Another question that I get here is, well, do I have to escrow? Do I have to pay my taxes and insurance with my monthly payment, or can I just handle those on my own? Depending on the loan program and depending on the size of your down payment, you might not need to escrow. You may just choose to handle this on your own. Some loan programs like FHA, for example, require you to have the lender hold these funds in escrow and distribute them for you. If for whatever reason you're handling your homeowner's insurance on your own and the policy was to lapse, then the lender's going to come along and they're going to do what's called forced place insurance. So now they're going to pick the insurance company for you. They're going to slap that on the home and the mortgage, and they're going to bill you. Okay, so just be mindful of that consequence. Should you have escrow or not? What's better for you? Honestly, it's personal choice. Given the option. And I think for most especially first-time home buyers, just have your mortgage payment included with your taxes and insurance. Don't try to make it harder on yourself. Don't try to manage it. If you are a property manager, you have a lot of experience with this, you have multiple rental properties, that's a different conversation we should have. Another piece of this, I get this question often as well, closing on the home, and it looks like I'm double paying because I paid for my first year's premium of my homeowner's insurance, plus they want a couple of months of additional homeowner's insurance, and I'm paying for my taxes in advance. Am I double paying? What's going on here? And that is not the case. You will never be double paying. As an example, it's currently May of 2024. So if you closed your mortgage payment, closed on your home today, you wouldn't make a mortgage payment in May or June. You would not have to make a mortgage payment until July 1st. So understand that those funds are collected in advance so that when the taxes and insurance are due, there's enough money there to make the payments. Another question I get around this topic very commonly is, hey, Scott, what's going on here? I have a 30-year fixed mortgage and my mortgage payment went up. I just got this bill from my bank and my mortgage payment is now $300 a month more than it was before. What the heck's going on here? Well, the truth is your mortgage payment actually didn't go up. Not if you have a 30-year fixed mortgage. That would be illegal. And if that actually did happen to you, you'd have very good cause for a lawsuit. So trust me, that's not what's going on here. What actually happened is, in most cases, it's your property taxes that have been increased. The county decided to levy an additional tax, probably to everyone in the county, and that's what's reflected on your statement, and or your homeowner's insurance went up. So if there's a payment change with your mortgage, most likely it is your taxes and your insurance. I hope that's helpful to you. And if you have any specific questions about how this works, please reach out to me. I'd be more than happy to help you.